Hello and welcome to this video on balance sheets for investors. As an investor, it is important to have a solid understanding of how to read and interpret a balance sheet. In this video, we'll go over the basics of balance sheets and how it shows a company's financial position. We'll also cover the main balance sheet ratios and how to utilize them to assess a company's financial health and make investment decisions. If you like this content, please remember to hit the like button and subscribe. So sit back, relax, and let's get started. A balance sheet is one of the fundamental financial statements provided by companies. It provides a snapshot of a company's financial position by showing what it owns, what it owes, and what is left over for its shareholders. The balance sheet equation is expressed as assets equals liabilities plus equity. This equation shows that a company's assets are financed either through debt or owner's equity. The balance sheet provides investors with important information about a company's liquidity, solvency, and financial health. By analyzing a company's balance sheet, investors can gain insights into its financial strength and determine its ability to pay its debts. It is an important tool for making informed investment decisions. A balance sheet is divided into two main sections: assets and liabilities. Assets are resources owned by a company that can be used to generate future economic benefits. Examples of assets include cash, investments, property, equipment, and inventory. Assets are classified into two categories: current assets, which are assets that are expected to be converted into cash within 1 year, and long-term assets, which are assets that are expected to be held for more than a year. Liabilities, on the other hand, are obligations or debts that a company owes to others. Examples of liabilities include loans, bonds, accounts payable, and wages payable. Like assets, liabilities are also classified into two categories: current liabilities, which are debts that are due within 1 year, and long-term liabilities, which are debts that are due beyond a year. Ideally, an organization would have more assets than liabilities, giving it a positive net worth. As investors, we are obviously interested in the profit and loss statement and key metrics such as price-to-earnings ratio. However, the balance sheet is sometimes overlooked in analyzing investments. A balance sheet provides valuable information used to assess a company's liquidity, solvency, and overall financial health. Let's review each. 1. Liquidity. Liquidity refers to a company's ability to meet its short-term obligations as they become due. We evaluate liquidity by analyzing an organization's current assets and current liabilities. If a company has a large amount of current assets relative to its current liabilities, it may be in a stronger liquidity position and better able to meet its short-term obligations. 2. Solvency. Solvency refers to a company's ability to meet its long-term obligations. This can be evaluated by analyzing the company's long-term liabilities and its assets, including its equity. If a company has a large amount of equity relative to its liabilities, it may be in a stronger solvency position and better able to meet its long-term obligations. 3. Financial health. A company's financial health can be assessed by analyzing its overall financial position, including its liquidity and solvency. Other factors, such as its revenue and earnings, can also be considered. If a company is generating positive earnings, has a strong balance sheet, and is in a strong liquidity and solvency position, it would consider to be in good financial health. Working capital is another important measure of a company's short-term financial strength. It is calculated by finding the difference between its current assets and current liabilities. Working capital is important for investors because it provides insight into a company's ability to meet its short-term obligations and pay its bills on time. Positive working capital is considered to be a good thing, while a company with negative working capital may be at a higher risk of financial distress. Working capital is a key indicator of an organization's liquidity. Balance sheet ratios are financial metrics that are calculated from information in a balance sheet. They provide a way to analyze and interpret the information contained in a balance sheet and compare companies that you may be interested in investing in. Some common balance sheet ratios include: 1. The current ratio. This ratio measures a company's ability to meet its short-term obligations by comparing its current assets to its current liabilities. A current ratio of 1.5 or higher is considered healthy, indicating that the company has enough current assets to cover its current liabilities. 2. The debt-to-equity ratio. This ratio measures the amount of debt a company has relative to its equity and provides insight into its financial leverage. A high debt-to-equity ratio may indicate that a company is highly leveraged and at a higher risk of financial distress. 3. The quick ratio. This ratio is similar to the current ratio, but only includes the most liquid assets, such as cash and marketable securities, in the calculation. It provides a more conservative measure of a company's liquidity. 4. The asset turnover ratio. This ratio measures a company's efficiency in using its assets to generate revenue. A high asset turnover ratio may indicate that a company is effectively using its assets to generate sales, while a low asset turnover ratio may indicate inefficiency. 5. Return on equity. This ratio measures the profitability of a company by comparing its net income to its equity. A high return on equity may indicate that a company is generating strong profits and may be a good investment opportunity. Investors should consider these and other balance sheet ratios when evaluating a company's financial health and risk. But it's also important to consider other factors such as market trends, industry conditions, and the company's overall financial performance. Balance sheet ratios should be analyzed over time to track the changes in a company's financial position. This helps in identifying trends about the company's financial health. Understanding a company's balance sheet can help you make better financial decisions. By understanding the principles of liquidity, solvency, financial health, and the key balance sheet ratios used to analyze them, you can better evaluate the likelihood a company may experience an adverse financial event. Thank you for watching this video on understanding balance sheets for investors. I hope that you now have a better understanding of this important financial statement and how it can be applied to make better investment decisions.